All right, if you're watching this video, you're here because you want to learn how to build a company to exit and sell for life-changing money. But if you're building a company to sell, the way that you do this is completely different than how you build a company for profit. It's a completely different avenue. Most entrepreneurs focus on short-term revenue, vanity metrics, and trying to scrape profits up. But if your goal is to sell for a high multiple and exit, you have to engineer it for value, not just income. I have spent the last decade in the venture capital world and served on a turn team for one of the largest private equity groups here in America. I have scaled and exited multiple companies. I've even taken a few companies public. I've taken a company from 60 million to 3.7 billion, and I've scaled and exited a lot of companies for large multiples. And in today's video, I'm going to show you exactly how to build a business to sell. First, let's get something straight. Most founders are solving the wrong problems in their business. They're getting spun out on minors instead of focusing on the majors. And majors, when it comes to an actual exit, is infrastructure. Infrastructure that supports scale, that actually attracts acquisition. Until you fix the foundation of your business, there is nothing to optimize. When venture capital firms or private equity groups evaluate a company for acquisition, they really look for two primary domains. They want to make sure that you as a founder have your client acquisition dialed, and they also want to make sure that you as a founder have also spent time optimizing your back-end operations. These two components dictate your growth potential and your profitability. They determine whether your business is worth a 3 times multiple or a 10 times multiple. Now let's start with the first element that we always look for when we're trying to acquire a company. The first thing that we look for is client acquisition. This is the very first question that we ask a lot of the companies that we put money into. Do you know what it costs to acquire a customer? Do you know what their lifetime value is? Do you know what your return on ad spend is? What traffic mediums are you leveraging from a paid perspective? Are you leveraging Facebook ads, YouTube ads, Google ads? I want to see those metrics. Are you running Instagram ads? Are you running high converting sales funnels? Or are you just sending people to an outdated website and hope that they buy? You see, if they don't have this data, then they have a real systems problem because they have no measurable, predictable, or accountable way to generate clients on demand. Because if you can't predict how to acquire customers at scale, you don't have a business. You have a hobby. It's not an asset at that point. There's still work to do. Now, on the flip side of this, the back end of your business is what turns all of your revenue into margin. And this is where most founders lose money without even realizing it. And here's how. What they really want to focus on when we're looking at acquiring a company is we need to make sure that systems are in place to manage delivery, fulfillment, scaling operations, what automations are being used to really cut down on all of that administrative waste, who built the SOPs in the business, are they documented, what does the team structure look like, how is change management handled in the organization, and also how do these folks onboard and ramp up new employees? What is the training infrastructure that exists, and what is the turnover rate of their employees? And most importantly, what are they doing to continually force folks to become better leaders and hold all their leaders accountable to grow? Because here's the truth. It is very simple to grow a business fast. It is much harder to grow a business well. And if the back end of your business cannot support the front end, you will scale yourself into a nightmare and completely deplete all of your profits while you do it. You need to build a business that someone actually wants to inherit, not a business that is not appealable whatsoever. Now, I want to give you some real world examples. A friend of mine just reached out to me a couple days ago with a company that he wanted me to look over. And the first thing that I did was start doing competitive market research on this company and quickly came to the conclusion that even though they're a high growth company, they only have 370 website visits in the last 30 days. So the next thing that I did is I went to a company that I know that I helped sell for $100 million, which was an exit, and I looked over all of these metrics. What we found was that website had 265,000 visits, 47% of the traffic was coming from Facebook ads, 41% of the traffic was coming from YouTube ads, and literally they pushed 90% of all of their traffic to a high converting sales funnel, not a website. It was an actual funnel. They tracked every click, they looked at every conversion, every dollar amount, and this is the difference between guessing and engineering in business. One individual is hoping people convert. The other individual is building a system that makes their conversions inevitable. And this is the key to building a business for scale, because here's what the kicker is. Most companies, they don't need to even spend money on a CFO. They don't need to focus on the things that they are focusing on. What they need to do is understand how to build an infrastructure that scales. Because if you've only got 375 website visits, that's your problem. You don't have accountable attention, and you don't have enough attention. And if you don't have attention, you can't supply it. Now, let's go deeper and look at what venture capital and PE groups actually evaluate when they are buying a company. The first thing is the team. Investors bet on people. They want to see the founders are committed, willing to do whatever it takes, and they're an asset, not a liability. They have to be coachable, they have to be surrounded by leadership, and they have to be able to execute. The second thing that they look for is the market size. The TAM is something that we regularly talk about. And this is your total addressed market share. Are you big enough to justify an investment? Third, they want to know the product is different from most. Do you have actual IP? Do you own something? Do you have networks that affect the brand? Do you have something that you've built that's unique to you? And fourth, they want to see customer acquisition dialed. You have to know your CAC, your LTV, your return on ad spend, and you have to be able to show that if they dump money into you, you're going to spend that money and generate a return on that money. And then the next thing that they have to look at is the back end of your business. Are you set up for scale, or are you going to be a headache to acquire, and they're going to have to come in and destroy your entire company? The sixth thing that they want to know is, are you structurally sound? This means, do you have a clean cap table? This means, have you ever over leveraged your equity or, buried your company in toxic debt? And finally, they want to see your exit strategy. Are you IPO ready? Do you have a path of acquisition? Is there a possible roll up that they can perform? Is there a strategy in play that you're building, or are you just building blind? Now, let me break this down one simple framework. Client acquisition must be systematized, tracked, and scalable. The back end of your operations must be clean, automated, and built to support growth. Your leadership team must be strong, accountable, and your market size must be big enough so you can actually get investment. Your financials also need to be clean, and you need to have an exit path that can actually be defined. If one of these is broken, you're going to cap the multiple that you're going to get on the exit of your company. Or worse, you won't even be able to sell it at all. And here's the truth that nobody wants to tell you. Building a business to support a lifestyle is not the same as building a business to sell. They are different games with different rules. One is all about freedom today. The other is all about legacy and life-changing wealth tomorrow. If you are serious about engineering a high value exit, if you want to become the type of founder that VCs want to buy from, if you want to scale it the right way, then what I want you to do is check the link directly below this description of this video, because this is what I do. What majority of folks don't realize is, yes, I own Luxvoni, but where I make all of my money is I have partnered with these venture capital firms, and they bring me companies that they invest in. This is all I've been doing for the last decade, and I know how to build and sell companies and set them up for scale. So if this intrigues you and you want an exit, you want to do it the right way, and you want to build something that, one, you can walk away with a lot of money, and I can also take a piece for helping you, click that link below and we'll see you on the other side. Be great, enjoy the day, and remember, you're just one exit away.